The board of Chipotle Mexican Grill recently approved a 50-for-1 split of its stock. But what does it mean for us as investors? Does it create an investment opportunity? And if it does, should we buy it? Well, let's find out. So first, what is a stock split? Well, let's say a company has 1,000 shares and every share is selling for $1,000. So the market cap of the company is $1 million. And one day the company decides to make a 10-for-1 stock split. So suddenly they have 10,000 shares, but every share is worth 10 times less. So in our case, $100. So the market cap stays at $1 million. So why do companies make stock splits? Well, it does not create value on its own. However, investors usually react positively to stock splits, partly because these announcements signal that a company's board wants to attract investors by making the price more affordable. And if there are more people willing to buy a stock, the price goes up. And Chipotle intends to seek shareholder approval for this split at its upcoming annual meeting in June. The CFO of Chipotle said, "This split comes at a time when our stock is experiencing an all-time high driven by record revenues, profits, and growth." So they are on the top of a wave and want to push the value of the company even higher with this stock split. So maybe the split is a sign that the price will continue to go up. But that is just speculation, and we want to invest and not speculate. So let's take a look at the fundamentals. If you were to invest $1,000 into this company 10 years ago, you could buy around 1.9 shares, and now they would be worth something close to $5,610. And that is a gain of 461% in 10 years. So a very, very nice gain. Individual insiders, that is an X, 0.7% of the company is owned by individual insiders, and we would like to see it over 2%. So unfortunately, the management does not have a lot of skin in the game. And are individual insiders buying? That is also an X. Overwhelming majority of transactions from insiders are sale transactions. And do super investors own this company? That is a check. We see 2 super investors owning shares of Chipotle, and they are Bill Ackman and Lee Ainsley. And are they buying right now? That is an X. Both of them are selling a substantial number of shares and making a nice profit while doing so. Return on invested capital, that is a check at 12.7% 10-year median returns. And we want to see this number higher than 10%, so that is a nice return. And what do we know about net profit margin? It is a check at 12.4%, and the industry median is just 4%. Actually, only Wingstop, Restaurant Brands International, Yum Brands, and McDonald's have higher profit margins. So Chipotle is right there near the top. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 12.5% of their shares. So long-term investors are owning a bigger part of the company without investing extra money. And the debt? It is a huge check. They don't have any debt. And that is something I really love to see. Because as Peter Lynch used to say, it's very hard to go bankrupt when you don't have any debt. Revenue growth, that is a check at 11.9% 10-year compound annual growth rate. And we would like to see this number higher than 10%. And what do we know about free cash flow growth? That is also a check at 14% in the last 10 years. Considering that this company is worth over $80 billion, such growth is impressive. And earnings per share growth, that is a check at 15.5% in the last 10 years. So it is even higher thanks to the share repurchases. Chipotle Mexican Grill is not paying any dividends currently. And because they have such a nice growth and a decent return on invested capital, it makes sense not to pay them. It is just better to invest it all into the business and make it even more valuable. Price to earnings ratio is 66, so at the first glance, Chipotle looks very expensive. But let's value it using a discounted cash flow formula, and for that we will make an educated guess about its future growth. So in the low scenario, we will estimate a growth of 12% for the first 5 years and then 8%. In the medium, 15% and then 10%, and in the high scenario, 15% for the entire 10 years. So in the low scenario, we expect a substantial slowdown in growth of Chipotle. Medium is predicting that it will slow down, but not by much, and the high one is predicting that they will continue to grow at the same pace for the next 10 years. So with such estimates, the intrinsic value in the low scenario is $1,032, in the medium $1,238, and in the high scenario $1,450. But we should apply a margin of safety to these prices. You can use any margin that makes you feel comfortable, but I always use a 30% one. And with such a margin, we get in the low scenario $723, in the medium $866, and in the high one $1,015. And the current price is around $2,926. So just as price to earnings ratio suggested, Chipotle is very expensive. It is a great company, very nice growth, no debt, beautiful margins, but it is just too expensive. But maybe the stock split will make the market even more irrational. We know it is possible, but after every high, there comes a low. So it is very useful to know how strong a certain company is. We can just put it in our stock ranking, and when the price drops, we will be ready to pull the trigger. So Chipotle is such a strong company, and I will keep an eye on it. I would love to own it, but the mindset of no price too high destroyed a lot of fortunes in the past, so we should be very careful. If you enjoyed this video, you may want to check out my analysis of McDonald's or Restaurant Brands International. Thank you so much for watching, and see you in the next one.